Tyler, one of the things that you and I've talked about a lot is that no matter whether the market is in a crash or at all-time highs, if you look in the right places and if you spend enough time turning over stones, there's always something that is worth buying. We got a couple stocks we want to talk about that we think are some of our top stocks to buy right now. You ready?
Let's go.
All right, I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go check out our special link. It'll be on the screen the entire video. It's fool.com/unscripted. If you go to fool.com/unscripted, you can get access to The Motley Fool's 10 best stocks to buy right now. It's a great opportunity to upskill your own investing success. Okay, Tyler, how about you go first? I'm going to talk about one that's been in the news a lot lately. It's Starbucks. I'm going to go ahead and put it out there. I'm going to break down why, even with a big jump the stock's taken this week, it's still one of my best stocks to buy right now. Let's talk about yours first.
So I'm going to go with a similarly beat down industry, and I'm going to go with the solar industry and go with First Solar. For you and I have talked about several other solar companies over the past year or so, no, mostly Enphase and Solar Edge, because they have been, they were having their very bad year. But First Solar has done notably better, and largely because First Solar's production is much more geared towards utility scale. They have this very, very large backlog of orders that's, I think it's like 76 gigawatts of production right now that are worth of production that's kind of booked. And at current run rate, I think of something like 14 gigawatts. That's several years of production just kind of sitting waiting for it to get done. So there's not the lack of revenue or customers that, residential solar players have today. I think part of the reason the stock has been hit is because a couple things. One, margins are a little bit lower, and its cash flow has been considerably hard because they've been spending a lot of money on increasing production capacity. This in July of this year, they brought on their R&D manufacturing facility in Ohio, should add about a little less than a gigawatt per year of production capacity online. This quarter, they're expecting their Alabama facility that's going to add 3.5 gigawatts of annualized production to the mix. And then next year, right around this time, they're going to bring on their other, I think it's Louisiana facility, another 3.5. So we're talking about 7.9 gigawatts of annualized production in the next 12 months. That is basically 50% increase in its production. So we're going to see a significant uptick in total volume shipped. And as a result, pricing be what it is, there's a good chance that, prices could go down. But for the most part, with a significant uplift in production like that, there's a good chance that we're going to see some pretty significant uplift in revenue and earnings over the next year. The stock is trading right now at about 20 times earnings, not the cheapest I've ever seen for solar ever go, not the most expensive either. I would say it's relatively fairly valued at this price. Still, when we talk about the solar industry, First Solar has proven to be one of the better operators for the longest time. It was very, very slow to actually grow its production because they wanted to, be prudent about it. But it really seems they pushed all of their chips in over the past couple of years with these new developments. And I think the dividends are going to start paying off in the next 12 months or so.
Well, the decision to hold off on expanding capacity proved to be the right decision, Tyler. I don't think there's any denying that. Continue to build that strong balance sheet and has allowed them during a period that's been tougher for a lot of panel manufacturers that have more exposure to residential solar and maybe not as much on the utility scale. It's put them in a position that as their backlog has continued to grow, that they can make these aggressive investments at the right time in the cycle. So I think it's going to prove to have been the right move. I agree. It's fairly valued, but you're paying a fair price for the best operator in utility scale solar panel manufacturing. I think you don't underappreciate how valuable that is. Definitely Buffett's pay a fair price for a wonderful company versus trying to pay a wonderful price for a fair company, because that's a tough industry. So I'm with you as a shareholder. I'm with you there. Okay, I said I'm going to talk about Starbucks, and I'm going to talk about Starbucks indeed. So I've already made one video. It was just me earlier this week highlighting how big of a get it was for Starbucks to get Brian Niccol from Chipotle. I want to highlight a couple things about Brian Niccol and why that is certainly part of my thesis. It's not the whole thesis, but it's just kind of a cherry on the top for Starbucks. Again, watch the previous video that I did to really get more detailed information about how important Brian Nichol was to turning Chipotle around. A lot of people have forgotten now that when he came on board, Chipotle was in a mess. They were they were still trying to recover from the E. coli outbreak in the West, where I think several people died and hundreds of people got sick. They got a double whammy when some dumb employee showed up to work in the Boston area with norovirus, spread that highly contagious virus that makes people throw up and got a lot of people sick. And it took years for the company's revenues to fully recover.
And there was also some of the operational issues too under the previous leadership. Throughput was an issue. Some of their sourcing was a little bit issue. I think previous management had tried to really focus in on local management or local sourcing, which gets really hard when you're a national chain of Chipotle size.
Yeah, that's exactly right. And the idea with Nickel was going to be that he was coming from Taco Bell, which was known more for like food innovation and kind of gimmicky stuff. And the idea was that's what he was going to bring to Chipotle. And the reality is that he was a process focused and has been a process focused leader. Exactly what you're talking about, Tyler. And as much as Chipotle still tries to source ingredients locally, the biggest thing they've changed is the ability to actually have chain of custody and to track where every single ingredient came from, when it came from there, to be able to prioritize food safety. They've done an incredible job there, bringing technology in to lower costs and improve throughput, expanding how they produce food, adding a make ready on the back line, so their ability to fulfill orders more quickly. Drive-throughs, 80% of their new locations have drive-throughs now. So all of those things, those are the things that Brian Nichol really brought. And carrying that over to Starbucks, this is a business that operationally has taken a massive step backward over the past 2 or 3 years. Really, you got to go back to before the pandemic, the last time you saw Starbucks really executing at a high level from an operational standpoint. And I think Brian Nichol is going to help solve those. So my interest in Starbucks, longtime shareholder, sold off back before the pandemic, moved on, decided to re-enter and open a position sometime over the past several months. I've taken a starter position. I've been really eyeing it closely, looking to add and to build out that position even more because this is such a powerful brand that has some really strong built-in durable competitive advantages. A lot of times people talk about moats and they say BS things like management. Management's not a real moat because as we just learned, management can change in 24 hours. So that's not a durable competitive advantage. Brand power can be a real powerful moat. Starbucks has a strong moat in its brand. It also has cost advantages. When you're the world's largest buyer of a commodity like coffee, you get a cost advantage. They have that cost advantage. We've seen that they have some level of pricing power too. They have some ability to raise prices. Historically, they've raised prices over the long term at a higher rate than inflation, and they've improved their margins as a result. The past couple of years, the bigger issues they've had is with traffic, with keeping customers happy. They're dealing with a period now. I'm going to share this on the screen. This is something that's probably the biggest thing that's undermined the company's results and ended up being a big thing that led to the change in leadership. Right here, comp stores on a global basis fell 3%. So what is comp sales? That's sales at locations open a year or more. So you're comparing it to the prior results from the exact same business a year ago. 3% decline. This is a big one. 5% fewer transactions. That's 5% fewer people coming into your store, ordering a cup of Joe. They increased prices. Everything went down there. So we saw a big decline in North America and a huge, huge decline in China, right? Ticket prices went down and the number of average tickets went down. So as much as we saw the company, what management provided was a pretty cohesive plan moving forward. When the board got word that Brian Nichol was somebody that they could bring in, you can add a Hall of Famer. You might even move beyond a above average CEO. And I don't think the evidence supported that we even had an above average CEO leading Starbucks before. Brian Nichol is a Hall of Fame caliber leader. You take a Hall of Fame caliber leader and you combine it with the competitive advantages and the real durable strengths of a Starbucks, and there is a lot to like. Now, here's the last thing. Starbucks is a big business. It's still growing, but when a business gets this large, it is the dominant player in its market, which is a mature market. You have to pay fair value. This isn't like a growthy startup that can 5x its revenues in the next 7 to 10 years, where you can pay a high valuation and still make money if they execute really well. You have to pay a good valuation for a company like Starbucks. We'll start right here. Price to earnings ratio, about 26 and a half times. Looking over the past decade, it's traded for close to 40 times earnings. That doesn't mean that anything less than 41.49 times is cheap, because the company has gotten more mature, has gotten larger. You're going to see that multiple average lower over time just because of the size of the company and its ability to continue to grow. I also think looking at cash flows is a useful thing here. So price to operating cash flows, 16.6 times. Again, 27 times, probably that's too high now, but you're talking less than 17 times cash flows. I think that is a very reasonable price to pay. The last thing, I'm not going to share it on the screen, but the dividend yield's about 2.4% right now. Long-term average is less than 2%. Great dividend growth story here that can really juice your returns. Locking in today's dividend is like 57 cents a share. You buy Starbucks at these prices and you hold it for the next 10 or 20 years, that dividend growth alone, the future yield that you can get on your cost basis, drip it into more shares. I think Starbucks is absolutely a buy right now.